Welcome, I am Ernie Goss, McAllister Chair here at Creighton University in beautiful downtown Omaha, Nebraska, and Creighton's campus in beautiful downtown Omaha, Nebraska. And I'm here on the first business day of the month, as always, to report on business conditions for the Mid-America region for the month of January. Now, the Mid-American region stretches from North Dakota and Minnesota in the north, right down the middle of the country to Oklahoma and Arkansas in the south. And this is a sort of a canary in the coal mine, although it's not been a very good canary lately, meaning what we've seen some negative numbers, they have not spilled over into the broader economy. Now, what did we get for the month of January? Growth slows again. It's the sixth straight month that the overall index has been below growth neutral. That's troubling, but here's the good thing. First increase that we recorded since June of last year. And another good thing, well, unless you live in those two states of Oklahoma and Oklahoma and North Dakota, sorry about that. Oklahoma and North Dakota, two energy producing states, their numbers were below growth neutral. All the others were above growth neutral. So what we're seeing is 7 states were above growth neutral. 2 states were below growth neutral, pulling the overall number below growth neutral. Now that, again, the number advanced to a still weak 48.3, and that's from 39.6 in December. So pretty big jump, and as I said, first increase since June of 2015. Now here I'm showing you a graph that charts both in beautiful Creighton blue in Mid-America, and you see that big jump for this month. Now, it's still below growth neutral, and you see the U.S. number there in red. Now, I didn't plot the number for January for the U.S. because it hasn't come out yet. It comes out later on this morning. I expect it to come down as well. I shouldn't say come down as well. I expect it to come down and be below growth neutral as well. Our employment gauge increased to 49.3, still not up to 50, but moving that direction from December's very weak 37.1. Now, this is remarkable statistic, I'll just tell you. We've lost in the 9 states 20,000 durable goods jobs over the last year. Now, if you look at the U.S., the U.S. has a positive reading there. So if you look at almost all the jobs lost across the U.S. for manufacturing are focused right in these 9 states. Inflationary pressures rise to a modest 52.4 from December's 48.2. Now, that's pretty good. In other words, it's just modest inflationary pressure at the wholesale level now. Keep an eye on that. Now, those were good numbers. Now, what should you watch for in the next month between now and our release on March 1st? First off, keep an eye, look at the jobs report, which comes out this Friday, and that's from the Bureau of Labor Statistics. That number's been very good, but the economy's not been good. So that's a real problem. Take a look at how many jobs are announced that come out across the U.S., but also look at the wage number underneath it all. It's been growing at about 2% year over year. If it should trend upward, that would be somewhat of a problem for inflationary pressures. Then short-term interest rates would come up. So keep an eye on that. Secondly, productivity for the fourth quarter will be released on February the 4th. That's an important number. Why is that? Because we've been adding all these jobs, but the economy is growing at an anemic pace, 0.7% for the fourth quarter annualized. Not good. So in other words, we're adding a lot of workers, but not much output. That's a real concern. And the third factor to watch is the core CPI. Now, that's the CPI, Consumer Price Index, stripping out food and energy. Now, that number has been about 2%. Now, you say, well, I haven't heard that, inflation. Well, the headline number, which includes food and energy, has been low because energy's been coming down, energy prices. So look at that. If it should, say, move up to 2 to 2.5, again, a problem for short-term interest rates would be pushing upward, and the Fed that meets again in March would be raising rates then. But in advance of that, we would even see higher short-term rates. What are some risk factors? Chief among them is the value of the U.S. dollar, just moving higher, higher, higher. As we have problems in Venezuela, as we have problems in even Puerto Rico, which of course uses the dollar, but even there, $70 billion of bonds that are in trouble. So keep an eye on that. The second factor is inflation. And there you're going to see it in the 10-year Treasury. I don't expect to see it there, but if it should, the 10-year Treasury, if it should move up to 2.5%, is nowhere close to that. It's about 2%. And finally, flattening of the yield curve. Now that sounds very complex. It's not. What flattening of the yield curve means is short-term rates go up, long-term rates come down. Now why is that a risk factor? It's because the Fed is getting it wrong, the Federal Reserve, meaning the Fed controls the short-term rates, which would be going up. The long-term rates, which are controlled by investors, that's all of us, would be coming down. And the reason it's coming down is it's saying the economy is slowing down, and the short-term rates are going up because the Fed's afraid of inflation. And when short-term rates get above long-term rates, we call that an inverted yield curve, and that usually indicates a recession ahead. I don't expect it, but keep an eye on that. So that's it for the month of January. This is Ernie Goss here, the first business day of February, saying, hey, it was a pretty good report, at least for 7 out of 9 states, North Dakota and Oklahoma excluded. Not as good for them because of energy. So until we meet again on March 1st, we at Creighton report on the Business Conditions Index for the month of February. Between now and then, may your economic cup runneth over, and thank you.